Great, guys, let's get started. Welcome to the room. Hopefully you, well, maybe you haven't been with us before, but hopefully as we go through today, if you haven't been with us before, you'll understand how we approach things. And if you have been with us before, it will reinforce what you already know, or maybe teach you something new. So let us know in the chat box if you have been to any Tradictive or Trade with UFOs webinars before. If you've been to, I don't know, any of the YouTube sessions we do or FX Street sessions that we do, let me know if you're completely new to us, never heard of us before, never done it before. Obviously, let me know as well if you've been doing it for years. The more I know about how much you know, the easier it is for me to make sure that I give you sort of adequate or information that's more relevant to you guys. So before we start, I just need to go through the disclaimers. So I'm just going to click there on the screen. The disclaimers should then, there you go, they are highlighting there. So it's important for you guys to read the disclaimers, not just for legal reasons, but it does also just give you a good idea that everything that we go through in these kind of sessions are demonstrations. So I'm showing you guys how we use the technology, how you might apply it to the markets, but ultimately it's up to you to decide what you trade, when you trade it, how much you trade with, whether it's live, whether it's simulated. That's up to you. Okay, cool. So for those of you that don't know me or you haven't been in these sessions before, my name is Becky. My email address is there on the side. I know it's on its side, so it might be a little bit hard to see. So it's becky@tradictive.com. So if you have questions during or after the session and you want to contact me, you can email me. Now, actually better than emailing me is to use this link here, tradewithufos.com/Becky. Now, why am I saying use that link? Because if we just go to it now, because if you just go to that link, you'll come to this page. You can set yourself up a free membership. Once you have a free membership, you can come down and ask a question here. Now, that for me is better that you ask questions in that space than on an email because it's a public space. Other people can see the question, other people can see the answers. So it might be that you come and you're looking for a particular answer and the answer is already here and these questions already have been asked. So it saves you time to come here and check that question's already been answered than it would be to type out the same question to me. Or maybe the question that you're going to answer is not here already, in which case you ask the question in a public forum, and again, you're helping others then to be able to see the answer to that. So again, if you have questions for me, by all means, you can email me if you'd like, but doing it in a public space is normally better so that other people can see the answers to those questions. So it's just tradewithufos.com/Becky and just set yourself up a free membership there so that you can ask the questions down here. Also on that link, tradewithufos.com/Becky, you can book one-on-one coaching with me if you'd like to. Just click meet with me and follow the prompts through there if you'd like to do that. That's true, by the way, of the other coaches. So if you join us on other webinars, maybe with Boyan or maybe with Andrew, then same thing for them. It would be tradewithufos.com/Boyan or /Andrew, and you'd be able to book one-on-one coaching directly with them through that link as well. Okay, so let me know, guys, in the chat box whether you've joined me before, whether you were with me on the last session that we did just before Christmas, I believe, or whether you've been in sessions with us and Trade with UFOs before. That would be really helpful to know. Now, the last session we did, which was just before Christmas, I just wanted to show you guys here. I'm just going to change it to one screen there. I want the 55. There we go. Cool. So I'm just going to show you here what happened to this last trade that we had. So the black lines, and you'll notice this as we go through if we put a new trade on today, the black lines are where I put them on the chart there to highlight my entry and stop. The green lines are where I put my targets. So last time, which would have been around about here, this moment in time, we put this trade on. So we have our black lines here. This was our entry. This was our stop. We had a safety target here. I'll talk about safety targets in a little minute, and a final target up here. So obviously what we can see, which is kind of cool with this one, it came in, triggered us around about this time, which would have been Christmas Eve, and then went off almost immediately, hit the safety target, and then continued to go, nearly hit the final target, came back, and then continued along and hit our final target up here. So for those that were in the session last time, this is the trade that we took last time, this is the trade that we placed last time, and this is what happened to it. Of course, it could just as well been that price went straight through it and we lost that trade. We could have come out somewhere in between for a profit somewhere in between. Of course, there are different ways people can manage their trades. If you'd have trailed a stop, behind this movement, for example, and you moved a stop to up here or right at the top there, then of course you would have been stopped out at this point and wouldn't have got it all the way to the final target. That's up to you as to how you trail your stop and how you manage your trade. I tend to just leave them. It either hits my target or it hits my stop. That's how I see it. And in this case, obviously that worked out well to hit the final target. So what we're going to do is we're going to go through start to finish in a process to find whether or not we should be trading, and if so, which way do we go, long or short, and if so, where do we buy, where do we sell? So again, you guys let me know if you are new to this, if you've been with me before, if you've been with us before, if you know these apps, you know the methodology, or if you're completely new. If you're completely new, I'll go into a little bit more detail. If you've done it before, maybe I'll go through it a little bit quicker. Just going to change where I am here to the just generic paper trading here for this one. There we go. Okay, so first thing that we're going to do is we're going to come to the FX Street economic calendar. Why do we do that? For me, I use it not to help me decide whether I buy or sell, but I'm going to use it to help me decide, should I maybe avoid a currency today, or should I just be a little bit more aware? Should I manage my risk? So I come and I look at this week and I look at high impact news, and then I choose through the advanced filters, I choose the currencies that are relevant to what I trade, which to be fair are most of the majors, and obviously you can use those as cross pairs as well. So we can look at this and we can have a look and say, okay, today being the 13th, what's coming up that's high impact that could affect us? So we have today, this by the way is in New York time. So we have today, so our time in the UK would be, I guess that's 1:30 p.m. Would have some US news that could impact the US dollar, and we have some news which would have already come out today that could have affected the euro. So the US dollar might have some high impact news today, meaning that could be that we have a lot of trades and the high volatility or the impact of the news pushes price to our targets. It could push price to our stops, could increase volatility. For me, volatility is a good thing if you're on the right side of it, a bad thing if you're on the wrong side of it. It's not intrinsically good or bad, but just knowing ahead of time that you might have a little bit of volatility might mean that maybe you don't have more than one or two trades that involve the US dollar, so that you're spreading your risk against trades that have maybe nothing to do with the US dollar, just in case the volatility goes against you, kind of thing. So you're hedging yourself. So what I'm then going to do here, I'm going to come to TradeStation. Now, the reason I'm coming to TradeStation is because I want to use this as a scanning tool to help me figure out which of these markets are going to be best for me to trade. Now, if you've never used TradeStation before, don't worry. You can just go through TradingView or whatever other brokers that you use and just look through different markets. You might have a watch list. For me, I care most about where the probabilities are, and I want it to be quick. So I want to be able to efficiently look at something that tells me where I'm going to find decent high probability opportunities. Just seen there on the chat box from Tony, been trading FX futures but not FX yet. Currently in the on-demand Forex course with Jose. Okay, brilliant. So hopefully some of the things that I'm saying now, if you're in the middle of that course or towards the end, will make sense. They'll kind of be reinforcing what you're learning now with Jose and kind of show you a real life application of it as well. Good. So the first question we should always be asking ourselves as traders, always, should be, number one, should I trade and then buy or sell, long or short? Another way to phrase that might be, should I be long, short, or do nothing? Now, why do we have this bit in there? Should I trade at all? Or again, if you rephrase that question and say, should I buy, sell, or do nothing? Why would do nothing be an option? Because placing trades for the sake of placing trades is much more likely to result in you losing money. We don't want to be placing trades just to fill time or just to feel like we've been productive, if realistically we're not placing trades that don't have high probabilities, or that don't have probabilities one side or the other, or that don't have a decent return available, or that have to be high risk. So it's okay to decide not to trade. It's okay to look at the markets, see that there aren't any opportunities, and move on, go and do something else with your day, rather than place a trade for the sake of placing it and then most likely lose money. So first question should always be, should I be trading, and if so, buy or sell? So this is what this scanner helps me to look at, if I should be trading any of these, and if so, which way. So you might see on here, you've got these yellow boxes on the right hand side. Some of these yellow boxes will say near sensible. Some of them will say near hopeful, either long or short. Obviously, as traders, we want to be sensible. We don't want to be trading in a hopeful manner. We want to be sensible. Sensible obviously implies that we have more probabilities, we have more odds on our side. So that's the ones we want to be looking for. Now, on top of that, what we want to make sure is that this box over here, under the climate box, so this is true obviously on both sides here, we want to make sure that that has a color to it. Doesn't actually matter what color. It could be red or it could be blue, but that's telling us that we have confirmation either up or down, and then we can go and look at that opportunity. So in this example here, this top one, where it says near sensible long, we also have a blue box in this section. That tells us that we have a confirmed upwards climate probability to the upside. We also know it's a near opportunity, meaning it's more worth my time to go and look at the Aussie dollar right now. That's the currency pair we're looking at here. Makes more sense for me to look at the Aussie dollar because I have probability to the upside and a near opportunity. That doesn't mean I'm just going to go and place a random trade at whatever price. There's still a process to go through, but it has at least narrowed it down for me to show me where we see the probabilities. Just in there from Ishmael, also trade demand and supply with Forex. Yeah, and to be honest, it's kind of I guess a similar thing. We're looking there for zones in the markets that we would take, or for areas where we would be looking to buy or sell for price to come to first before we get into that trade. Now for us, what we're using here and what we like to do always with our trading is be as technical, methodical, logical, objective as can possibly be. So using our eyes to subjectively look at the market and see where we see patterns or see where we see something that we would be used to seeing is a great thing, and it's a skill set that takes people a long time to build, and great, good for them. And not to say that obviously that can't go very well. Loads of people can do really, really well subjectively looking at the markets. However, the key word in that is subjective. If you're looking at something subjectively, perhaps you might not see an opportunity just because you're a human being and you missed it. Or you might see something, you might get confused. Is it this? Is it that? So we like to use technology to just make the answers to those questions really, really easy. Now, you might use the technology for some things and not for others. You might combine it with other ways that you do things, other indicators that you use, with a subjective way that you look at things, with fundamentals, whatever. I'm obviously showing you our sort of pure methodology, as it were, following everything as we do. But there's nothing to stop you taking bits that make sense to you and putting that in there. By the way, the climate side of things, which is kind of what we're highlighting here, the climate, which is answering question number 1, should I buy, sell, or do nothing? The Auto Climate app that we use in order to scan the markets for this is a free app. You can get it on the App Store for TradeStation, and you can get it through TradingView as well. If you don't have that app or you want to get that app, you just need to go to that link, tradewithufos.com/Becky, give yourself a free membership or get yourself a free membership, and then follow once you've gone through that to download the Auto Climate app for free. So I'm just going to come now to TradingView and just show you what I mean there by the Auto Climate app. So I'm just going to go to the Aussie US dollar, because that was the one that we were looking at. The data here I'm looking at, by the way, is FXCM. I'm just clicking that because it's the top one. You can obviously choose the data that makes best sense to you, depending on which brokers you use. So the climate is what we have here on the left-hand side, bottom left-hand side. So the climate is answering the question for us. Should we be long, short, or do nothing? Just realized I'm on the wrong time frame there. There we go. Brilliant. I thought it should be up there. Should be a blue dot. Okay. So we have red dots and blue dots down the bottom here. You might see some of them are thick, some of them are thin. The way these dots are showing us things is to help us interpret, should we be long, short, or do nothing? If it's a thick blue dot, like we have at the end of this sequence here, then it's a good idea to look to go long. If it's a thick red dot, like one of these, then it's a good idea to look to go short. If it's a thin dot of either color, we do nothing. The color is actually irrelevant if it's a thin dot, because of what the thinness of the dot is telling us is that we don't have probabilities either side. If we have no probabilities either side, then it would be more of a gamble, less of an objective methodology to just go and place a trade for the sake of it. So again, we use the Auto Climate to tell us, should we do nothing? Should we be long? Should we be short? In this case, we're looking for a long opportunity. Now, just because we know it's a good idea to go long doesn't mean we just go and buy it wherever the price is now. Of course, you could do that. You could have you know, methodology where you do that and you figure out your risk management and stuff on top of that. However, I would say the chances of right now, whatever the price is right now at the time of day we happen to be sat down looking at the market to be the exact best price to buy in the day is very, very unlikely. So we want to make sure that if we're going long, we're doing it at the right place. Where are we buying? That's question number 2. So question number 2 we should be asking ourselves in any methodology, whatever you do, is if long, where? If short, where? Oh, short, where? Where do I have the highest probability to get into this trade? Where do I have the lowest risk? Where do I have the highest reward? So if I'm going to go long, where's the best place to do it? If I'm going to go short, where's the best place to do it? Now for us, this is where the UFOs come in. So clues in the name of the company there, Trade with UFOs. Trade with UFOs essentially is referring to these little flying saucers here. Now, I know they look like flying saucers and they're called UFOs, but it's actually nothing to do with outer space or unidentified flying objects. What UFO stands for is unfilled orders. Essentially, what this app is doing, it's scanning through the markets and it is finding where we have stacks of buy orders and stacks of sell orders. It's analyzing things like the structure of the price, but also volume, upticks, downticks, volume versus the amount of ticks. It's scanning loads and loads of different criteria in order to show us where we have the highest probabilities that there are stacks of buy orders waiting to be filled or stacks of sell orders waiting to be filled. Now, what I mean by that is if we have buy orders that are down here, the green UFOs show us buy orders, red UFOs show us sell orders. So let me just see if I can show you some sell UFOs. Maybe, oh, no, we don't want that one. We want that one. I'm just going to see if reloading it will show us stuff above. Okay, it looks like there are no sell UFOs. Oh, actually, there's some over here. So red UFOs are sell orders, green UFOs are buy orders. So over here on the right-hand side, we have some buy orders below us here. Now, it's showing us where we have high probability for there to be orders that are likely to change price. So if we have stacks of buy orders down here and price comes down, in theory, coming down and hitting this point, and you'll see the numbers are highlighted on the right-hand side there on TradingView. If it's hit that point, it's then hit a lot of buying. If we have a lot of buying in the markets, pushes it up. So it's highlighting to us areas that are likely to push price back up again if it's a green UFO. If it's a red UFO, let's say we had one up here, a red UFO of some kind up here, then if price were to go up and hit that line or hit that band, hit that flying saucer, then it's hit a big stack of sell orders likely to push price back down. So we're using these UFOs to answer that question as to where we do it. However, there's another layer to this. Again, you can just take it like this and just take the closest UFO to you. That's perfectly fine. However, the issue with doing that is that you'll see there are multiple different UFOs. We've got 4 here on the right-hand side. Which do we pick? Which one has the highest probability? Which one is more worth our time and money? This is where we layer in a third sort of odds enhancer, I guess, or a third sort of layer to what we're doing to increase our probabilities that whatever UFO we pick is more likely to work. So we come back over to the left-hand side here to where we would have done our auto climate, and we look here at our EMA. Now this is a 9 EMA, so it's a 9-point EMA. It's an exponential moving average that's looking at the last 9 data points. So in this case, it's a daily chart, so it's looking at the last 9 days. Now this EMA, the value for the EMA is there, so 0.7725. If I just move, there we go. That's the value of the EMA there, 0.7725. Now, why is that important? Now, the EMA is something that is used by a lot of people in order to get into trades. Retail traders all over the world, but also hedge fund managers. So, excuse me. So there are people all over the world, like I said, retail traders, hedge fund managers, that are using that moving average to enter a market. So as price comes down, they are likely to buy when it hits that moving average. And it goes up. And then the moving average continues. Maybe price comes down, hits the moving average, people buy, and price goes up. Now, not all the time, of course, we can see here that there's a few times where price goes through that moving average. The other way, by the way, is that if price is below the moving average, then in theory, if it comes back and touches the moving average, people would sell and it would push it down. So what we're saying here is there are orders to buy coming in at that EMA. Not necessarily enough to move price, but there are also orders to buy coming in at UFOs. So what if we combine the two? Then we've got more orders to buy around the same price point, which gives it more probability of actually pushing price up, which means the risk of our money in the market is in a better place. So in this particular example, we have an EMA value of 0.7725, which is, I guess, around about here. And as you can see, we have no UFOs around there. Closest UFO is a little way below there at 0.7617. So for us, this would be a no trade because we don't have enough probabilities layering on top of each other in order to make this worth our time and worth our money to risk on this trade. Now, like I said, you could be somebody that says, I'm just going to trade at the moving average, so I don't care about the UFOs, no problem. You could be somebody that says, I'm just going to trade at the UFOs, I don't care about the EMA, no problem. You could be somebody that uses other reasons, other indicators, other processes in order to get into trades, no problem at all. Like I said, the way we do things is we want to layer up as many probabilities as possible, and in this case, we don't have the probabilities that we want to see, so we just move on. So we'll then just come back to TradeStation, and we will look for other opportunities. By the way, I should have said at the start, obviously this is called Nailing FX swing shots. So we are looking at swing, also position trading as well we'll look at. So I'm looking at the bigger timeframes there, the climate timeframe that we're using, what we use our common timeframe, sorry, what we call our common timeframe of a 240-minute chart, a daily or a weekly. And also we've got daily and weekly over here as well. So again, we're looking at our trades to last a few days to a few weeks. That's the kind of style that we're looking to do here. Now, actually, the same methodology, the same apps, the same use of the technology applies to investing. It applies to day trading as well. But the examples we'll look through today will be swing-based. So if we come across over to this side, so we can look at some cross pairs here, we have on the top the Swiss yen. Swiss yen is a near sensible short. That's showing us there with that yellow box, and it's saying sensible, so great. We also have a thick red box there, which is telling us we've got that confirmed climate to the downside. So let's go and look at the Swiss yen. So I want to make sure that I'm looking at the Swiss yen on both of my charts so that I'm not doing analysis for one on one and analysis for a different currency on the other. So here we go. We'll be slightly quicker with this one. Now for some reason that's telling me that it's a confirmed upwards climate on this one. It was the Swiss yen, wasn't it? Swiss yen, near sensible short. Let's open that again. That's where we are. Let's try that. Okay, this might be a slight variation there with the spread and with the different brokers as to why TradeStation is showing something that TradingView is not, or that you'll see as I changed there between FXCM and Oanda, the climate information changed, which will be based on the slightly different prices that you'll get with different brokers. Obviously, I want to make sure that we're doing this process properly, so I'm going to go back to TradeStation and look for a different opportunity here. So we have New Zealand Swiss, near sensible long. I've come down to this one because all these three boxes are greyed out, so no point looking at them. We want a near sensible and we want that box filled in. So this is a blue box, so we're looking to go long. So that was the New Zealand Swiss. So let's have a look at that. Again, let's just make sure that we're looking at the right thing on both charts. Here we go. Okay. So similar kind of thing. It looks like we're not going to have an opportunity here as well because of the EMA. So just to show you again, we have an auto climate, tick blue dot, confirmed upwards climate, probability to the upside, look to go long. We have our UFOs on the right hand side, but our EMA is 0.6375, which is around about here. And as you can see, no UFOs around that point. So by the looks of it, it's already worked a couple of times actually, if the EMA was roughly there when this came back and hit this. So again, you could just use the EMA itself. Again, we want to make sure that we layer up those probabilities together. So no trade on that one, no problem. We come back to the scanner. Again, like we said, a lot of the time, we want to make sure that we are placing trades because there's probabilities, not to fill time. So it's okay to go through different opportunities and rule them out. Better to save your money than it would be to just place a trade for the sake of it. So we have this one here, Canadian Swiss. This is using a weekly climate. So we're going to change our time frames here. So Canadian Swiss sensible long on a weekly. So let's come here. Canadian Swiss, Canadian Swiss. Now I'm going to change this to a weekly chart. Looks like I would have had a trade on there before. Let's delete that. We've got a weekly chart on the left hand side, which means we want to be looking at a 144-minute chart on the right hand side. Now, just to say, I know that might be a little bit random and you might be thinking, where did that come from? It's because the time frame on the right hand side, the reason that it's a random number, it's a 144 instead of maybe a 240 or a 60 or a 120 or something that's more common, is exactly for that reason. It's less common, less people use it. More people are using the main time frames, and then they're the ones that are making decisions based on normally retail thinking. These off time frames are actually, you might notice, are Fibonacci numbers in the Fibonacci sequence. These off time frames are often used by computing systems, used by larger market players, which is why we want to be using our entry time frame for when we're getting into our trades on time frames like this, as opposed to commonly used time frames, because again, it gives us a slight extra edge to be finding where those buyout orders and sell orders are that are more likely to be placed on the time frames that large institutions are using. By the way, not to say that you can't use a 240 or a 60. Of course, they work as well. It's just we're, again, adding probabilities here. So we are going to look at this opportunity here, and I'm going to talk through a couple of different things in order to get this trade placed. So we have a confirmed upwards climate, probability to the upside, happy days. We're looking to go long. We have a UFO over here on the right-hand side. Now, we have an EMA value of 0.6948. Now, that is round about here. Now, so you might be thinking, okay, so this is no trade then, right? We don't have our EMA and we don't have our UFOs lined up. Now, what I'm going to explain here is that it's a little bit of anticipation, and you might want to put an alert on rather than place the trade itself to check that this all does obviously line up. So the EMA, clue is in the M in that, moving. It's a moving average. It moves with price. It's tracking the movement of price, and it's moving with it. So as price moves up, the EMA moves up. As price moves down, the EMA moves down. So it is being tracked. I'm just going to draw again where roughly the EMA is now. It's tracking price. So the thought process here is that if price were to come down to meet entry at this UFO, more than likely the EMA would have moved down as well. Now, not necessarily to be exactly within this UFO, so that's why you might want to put an alert on. I'm going to put the trade on for the sake of sort of finishing off this process and showing you the rest of the process. But again, you might want to put an alert on roundabout, so the EMA is here now. You might want to put an alert on roundabout here just before it would in theory enter. And just double check if it does line up, if that EMA has moved down enough to be inside this UFO so that you can then place that trade and you've got everything lined up the way you want it to be. So we're going to assume that we've put an alert on, but we're going to assume that this is a trade that we would be taking and that the EMA would move down with price and get into this trade with us. So we're going to use this UFO so I can show you how we would complete this process. So you notice that we've got numbers on the side here. The numbers on the side are referring to those dotted lines on the UFOs that are showing us like the top and the bottom band, as it were, or highlighting the top and the bottom of that band. So that's showing us the range in which we find these stacks of buy orders. So we're going to use these numbers to help us with our trades. Now, you could just take the numbers as they were and use those as your entry and stop. We like to give it a little bit of wiggle room and obviously compensate for the spread as well. So the top number there is 0.69355. So first thing I'm going to do is just round that up to the closest pip, which will be 6936. Then going to add a couple of pips. I'm adding a couple of pips because we're buying, so we want to make sure that we're kind of compensating a little bit there for the bid-ask spread. So we're going to put it to 6938. So we rounded it up to 6936, then we've added a couple of pips, so 6938. What I'm going to do is take my Fibonacci retracement which you'll notice doesn't look like a normal Fibonacci retracement. I'm going to double click on that, and I'm just going to show you here on the style tab in here. I've unchecked everything that, so it would normally look like that. Maybe it would have other things checked. I've unchecked them all, and I've just got 0 and 1, and I've done that because I'm using this tool just as a drawing tool to just highlight where my entry and stop is. I don't use it for what it's originally intended for, to be used as an analysis tool or as an indicator. I simply just use it as a drawing tool. So I'm going to highlight around that area with that where that UFO is. The reason I do that is because if I double click on there and go to coordinates, I can type over on here what numbers I want. So we just worked out that that entry would be 6938. So I'm just going to type in 6938, click OK. You'll notice that top line has moved there. Brilliant. Now where's my stop going to be? So we have 6930, 7, obviously is that percentage of a pip there. So I'm going to round that down to 6930. And I'm going to take away 5 pips to give me a little bit of wiggle room on that stop. So that's going to be 6925. I'm going to double click on that line, and I'm going to type over that. So it says 6925, click OK, and you'll notice that's moved slightly there. Now, why do I draw that on the chart? It's because as price comes down, assuming that EMA does line up and our alert tells us, and we can get into this trade. So if this comes down and fills these orders, then the UFO is not there anymore. The UFO is showing us where we have unfilled orders. If the orders get filled, the UFO will disappear. So we have these drawing tools that help us highlight this area. So it's much easier to see where we got in, where we got out, what went on with that trade. So brilliant. This is our entry and stop. So where are we going to place our targets? Pretty easy with the first one. So we have 2 different targets. Again, the way you use your targets is more personal. You might decide to have one target at 2 to 1 away, 3 to 1 away, 10 to 1 away. You might choose to have one target at an opposing UFO or rival UFO. You might choose to trail a stop and not have a target at all. That's up to you. Again, I'll show you how we do things. So I'm just going to put in here into trading view here. So 6938 would be the entry, and the stop loss would be 6925. So this is pretty cool because it's now telling me what my pips risk is, and therefore what my dollar risk is, assuming that those were the units I was using. I'm going to assume that our total risk on this trade is going to be $100. So $50 on the first one, $50 on the second one. Only because it's a nice round number, it's easy to split in half. It's just used as an example. Again, the risk you use on your trade is going to be completely relevant to you. Again, you might not even live trade, you might be demo trading, you might just be back testing or something like that. So again, this example is just an example. So $50 risk. So I know that I'm risking 13 pips and $50. So my first target is very simple. It's going to be the exact same amount of pips away. So you'll see here, this number here shows me my reward to risk ratio. My reward to risk ratio is 1 to 1 on here. So my target is now going to be 6951. I'm going to take a horizontal ray, draw that on the chart, anywhere random, double click on it. Maybe let's make it green so that it's a target. Go to coordinates, and I'll just type over there. So 6951. Again, I'm doing that to highlight easier on my chart. That's where my safety target is. That's where my target would be. Now, we use this target at 1 to 1 in order to get to safety, that's what it's called, a safety target, as soon as possible. So that way, let's say we have another target up here, and I'm making it up, but let's say it's up here. Price comes in, moves away, hits our safety target. We've taken half of our position off at 1 to 1, meaning the worst that happens now, if price was to come back against us and stop us out at this point, is we break even. We don't make anything, we don't lose anything. It could even get all the way up here, not quite hit the target, come back. Worst that happens is we break even, we don't lose. If we weren't to have that safety target and just have this target, price could come in, get close, come back against us, and we end up losing money despite the fact that we did gain some pips here. Of course, you could trail your stop behind as well to increase that probability even more, although that may reduce your overall risk to reward. So that's our target number 1. So very simple there. I'm just going to make sure I've got everything right. So 6938 is my entry, stop loss at 6925. That's my stop. And my profit target, my safety target, is the exact same amount of pips, a 1 to 1 target away. And again, in this example, it's a $50 risk. So I'll click buy, and there we go. That trade's gone in. So where do we put our second target? We don't just want to be taking one-to-ones out of the market and be getting examples or be getting trades where we just take little bits here or there. Yes, that might mean that we have a higher win-loss ratio, but we're not going to make very much money from that. And of course, we're in the markets because we're trying to make money, right? So where are we going to take our biggest target, our final target? We're coming over here to the left-hand side, back to this weekly chart here, and we're going to use the UFOs to help us answer that question. So we have here a red UFO. I've just realised my laptop doesn't have any battery. I've just put that on. Hopefully that's working. There we go. Cool. So let me just come off here. So with the UFOs there on the left-hand side, we have our red UFOs up here. Red UFOs are showing us where we have sell orders, where we are likely to see, if price were to ever get up here, we're likely to see price come back from it because there's going to be lots of selling coming into the market. Now, on the bigger time frame, on the weekly time frame, this is true of whatever methodology you do. The bigger the time frame, usually the bigger the impact, the more the probability or the higher the probability. So if we're going to be taking our target, we're getting in over here on the right-hand side. Move this chat box. There we go. If we're getting over here on the right-hand side, then we want to make sure that we can get as much out of that market as possible. If we have a climate to the upside on a bigger time frame, that's likely to take out sell orders on smaller time frames, but it might not necessarily take out sell orders on its own time frame. Hopefully that makes sense. So we're going to go for the red UFOs on the left-hand side as our final target. Now, obviously, there's a point to be made here in the sense that it's very, very far away. So this closest UFO, you'll see that the numbers here on the right-hand side, that lighter red one is 0.7380, which is quite a way away, a good few hundred pips. Now, we're a swing position trader, so I'm just going to squidge this down. 7380, if we were to put that on our chart, 7380. We're a swing position trader, so potentially, yeah, we're in this trade for a few weeks, might even be months before we get to this target, and great, that might go in our favor. We're still going to use that as our target because that's what the rules say, that's what the methodology is. But in things like this, where the target is very far away, what we're likely to do is also trail our stops behind UFOs. So what that means is, let's say this comes in, it's my entry, starts to move away. Let's say it then creates a new UFO here and continues. Our stop loss that was originally here, we move it to just behind this one. And then a new UFO is formed. And we move our stop to this one. So we're kind of locking in profits behind objective places on a chart where we see that we have likelihood for price to continue to go up. Because if price was to come back and go through this UFO, for example, what that likely means is that the climate is probably about to change. If it's breaking through buy orders in an upwards climate, that starts to signal to us that it might be turning in the other direction. So we want to get out here and lock in that profit. So again, especially when you've got final targets that are quite far away, you might want to implement something like that to lock in your profits as you go. So I'm going to come over here. I'm going to put in 6938, and 6925 was the stop loss. I'm going to make sure that I'm risking $50 here. And the profit target, I'm just going to type in the price here, because the price here is coming from the UFOs. So 0.7380. We can see there that's a 34 to 1. Now, of course, we are taking half of our position here. So essentially, actually, it's a 17 to 1. And then we would have made 1 to 1 on the other. So overall, we'd be making 18 to 1 on this trade. I think that's right on the math. Again, presuming that it went all the way up there to take our final target, what's more likely is that we would take profits somewhere in between on a trailing stop. But again, wouldn't it be great if we got that 34 to 1. So now, again, we're just going to click buy. Everything's in there. And we can see we've got our orders all set up on that. So like we said before at the start of this, let me just unsquish some things so we can see the EMA value maybe a little bit easier. The EMA value at the moment is 6949 and our entry is 6938. So again, our EMA at the moment is going to be, I guess, round about here. Again, we are assuming, we've put this trade on, we're assuming that as price moves down towards our entry, the EMA will come with it and that they will line up nicely together. If it doesn't, then we cancel the trade. If you have an alert on to let you know, Again, you can just check the alert. If it all lines up, then you can quickly put the trade on. If you've already drawn on the chart where your entry, stop, and targets are, then great. You've already got that reference. You just need to go and put that trade on, put those 2 targets in. So hopefully that makes sense, start to finish. You guys let me know if anything I've said doesn't make sense, if you have any comments or questions, if there's anything you want to make sure that I go over in more depth or something. We've got a few minutes left of the session, so I want to make sure you get the most out of it. If I've completely confused you, let me know. The good thing is that we do these sessions on FX Street, we do these sessions on YouTube, so you can join us as many times as you need in order to understand how we go through this methodology, in order to understand how we use the apps. In terms of the apps, like I said to you, Auto Climate, this app here, which helps us answer question number 1, do we go long, do we go short, do we do nothing, is free. You can download that from the website and just go to tradewithufos.com/Becky, fill in the free membership, follow it from there. The UFOs, depending on what platforms you use, will depend on the cost of the UFOs. For TradingView, they're $34 a month. For TradeStation, they're $89 a month. And you can cancel anytime. So if you're not already using the apps, then now you know more about them. If you're using other indicators, you don't have to use UFOs. You can use other indicators. Make sure whatever methodology you use, you are answering the questions. Number 1, should I be long, short, or do nothing? And number 2, if I'm long, where? If I'm short, where? So what should I be doing and where should I be doing it? Should be the 2 questions that you should be answering. Manage your risk. Make sure that you're risking no more than 2% per trade, and that's if you're like really risk tolerant, I guess. Manage your risk. Keep a log of things, back test stuff, and then whatever methodology you use, I really believe this, whatever methodology you use, as long as you are methodical and objective with the way that you do it, and as long as you track it, you can make it work. You can figure out what's going wrong, what's going right, what do you need to change, layer things in. What we don't want to do is be subjective all the time, changing our minds all the time, getting in at random places, getting out at random places just because the news said something one day, we felt like it another day, we used one indicator one day, we used a different indicator another day, and there's no consistency, which means it's really hard to then figure out what's going right, what's going wrong, what do I need to tweak. If you're using this methodology exactly as it is, again, track it, test it on different time frames depending on what's right for you, test it on different markets depending on what's right for you, and come up with something that you can prove works with data. So it's objective, not subjective, as much as can possibly happen, bearing in mind that we're human beings. So I can't see any questions or anything on the chat box, so hopefully this makes sense, guys. I'll be back in a couple of weeks. So I think it's a couple of weeks. So I'll see you guys then. Obviously, in the meantime, my colleagues do sessions as well, so join those guys, have fun with those guys. Also find us on YouTube as well. Again, any questions, ideally you would do it in this public forum. Go to that link and ask the questions here so that other people can see your questions and see the answers to it. If not, you can email me, Becky@tradewithufos.com. All right, happy trading, guys. Have a good one and see you next time. Have a good day.